So today we're going to cover this chapter 9. Well, chapter 9 is about budgeting. So we're going to see what the budget is, why do we need the budget, how to prepare the budget. Once we prepare the budget, what we can do about that budget. What is budget? Now, let's say why do we need the budget first, and then we're going to go to the point of what budget is. If you still remember the very first class that we have, we start talking about the activities that manager is doing and what management is. Now, what I want to remind you is in order to everything to make sense, in order this course to make sense, the first thing that we have before we become a manager, we have to get something to manage, right? So what will be that we're going to manage? We're going to manage how we're going to achieve something that we already set up. So before we start anything, because before everything that, in order everything that we study this course to make sense, the first thing that we have to have is we have to have a goal. Once we have a goal, everything starts making sense. So once we have a goal, once we have objectives that we want to achieve or goal that we want to reach, then we're going to start making a plan how to reach that goal. During the process of the planning, once we select the alternatives, once we identify the alternatives, once we select the alternatives, then we're going to prepare our budget. So what the budget will be? The budget will be a detailed quantitative plan for acquiring first and second using financial and any other resources over specified forthcoming period of time in order to achieve our objective, or in order to achieve our goal. Again, we having a budget, we having a plan only for one reason, because we have a goal, or we have objective. If we don't have a plan, if we don't have objective, if you don't have a goal, if you don't have objective, it doesn't make sense for you to make any budgets. So if your plan is to get a diploma from Alexander School of Management, then you start preparing the budget. What will be the budget? Again, that will be the detailed quantitative plan for what you're going to get and how you're going to use it in terms of financial resources and any other resources. Not only money. We're not talking only about money here. We're talking about any other resources as well, including the money. So the act of preparing the budget, it will be called budgeting. And the use of the budget for control organization activities, it's also known as budgetary control. So again, why we need to control the activities to achieve our goal or to achieve our objective. So for that reason, if we don't have a goal, if we don't have objective, there's no point to have anything. We're gonna use the budget for two activities, part of all the management activities. One will be for the planning. On the planning, we're gonna involve developing objective, preparing various budgets. Why do we need the various budgets? Because we can identify different alternatives. The whole objective is to reach our goal or to reach our objectives. Second thing, we're going to use the budget for control purpose. What meant control? If you still remember, control is not something that should be scary about. Control is simply the process of comparing where you currently are versus where you're supposed to be. Where you're supposed to be, you're going to see it on the budget. Budget is the one that tells you at which stage where you have to be. And the actual, when you see the actual results, you're going to see where you actually are. And through the control process, you're going to identify the discrepancy between where you're supposed to be in order to reach your goal versus where you are. Either you're going to be ahead, either you're going to be behind. So that's the objective of the control. Now, what are the advantages? Now, if you have a budget, then definitely you have a goal and objectives. So budget is going to help you to define your goal and your objective. Then the budget is going to help you to coordinate activities that you need to do in order to achieve your goal and objectives. Budget is going to help you to communicate the entire plan of the activities, which at the end is going to bring you to your goal and your objectives. Then the budget is going to help you to allocate the resources, not only financial, any other resources, in order to achieve your goal. Also, the budget is going to help you to think about the plan and to think about and plan for the future. Once you start preparing the budget, basically you're moving to the future and you start doing steps that's going to help you to achieve what you want to achieve, but in the future. And the budget is going to help you to identify and uncover potential bottlenecks. Bottlenecks will be any constraints that you may have during the process of achieving your objectives or your goal. Who will be how are we going to do this responsibility accounting? Responsibility accounting will be always we have to keep somebody responsible, right? But we cannot keep people responsible for the things that they cannot control. So for that reason, we're going to keep the manager responsible only and only for the items that they actually can control. To a significant extent, obviously. How are we going to prepare this budget? Well, there are different formats of the budget. The most common format of the budget is a rolling format of the budget. So once we have that in mind, that comes to the point, for what do we need that budget? Again, we need it for established activities, which is going to bring us to the goal. But we have two types of goals. First one is short-term goals, and the next one is the long-term goals. If we have the short-term goals are usually in the company, are related to the operating cycle of the company, which is the 12 months. And if we prepare the budget for 1 year or 12 months, that will be called operating budget. Why? Because we're dealing with the current operations of the company. Anything within 1 year, it's called company operations. Anything above 1 year, we're going to call it capital budgeting. Why? Because now we're moving ahead of time. The capital budget, when you're preparing the capital budget, usually preparing it for the long period of time, for 1 to 5 years. Usually 5 years is the maximum that is prepared that capital budget. But once we go with this operating budget, with our operating budget for the first 12 months of the operation, the different formats. One format is we to prepare this called rolling budget. Now, what a rolling budget will be? Rolling budget will be no matter which month we are, we're always going to have 12 months ahead. That means once we prepare the budget from January to December, once the first month of the year go, when the January is over and we start February, we're going to drop the January from the budget and we're going to add the January at the end of the budget. So we're still going to have 12 months. Once February is over, we're going to drop the February and we're going to add February at the end of the budget. And when we start March, we're still going to have 12 months. And we're going to keep rolling and keep rolling and keep rolling and keep that 12 months pretty much all the time. So that's called rolling budget. Now, how we're going to prepare the budget? There are two models of the preparation of budget. One is the top managers tells everybody else what the numbers are, and nobody has any comments on anything, any suggestions on any chances to change something. That will be one. The second option is participative budget. Participative budget means that everybody in organization is going to contribute into the process of creation of the budget. Imagine if we are in the hospital. So we have to prepare the budget for the Ministry of Health. So if you want to prepare if you want to do the participative budget, from where we're going to start? We're going to start from the nurses, since they're on the very, very bottom of the chain. We're going to start with the nurses and we're going to ask them what they need for the next year. Then we're going to ask the doctors. And once we get the nurses and doctors, all the hospital is going to prepare their own budget based on everybody's needs. Now the hospitals from the city is going to submit all those budgets to the province. The province is going to combine the budget from all the cities and is going to send it to the federal government. The federal government is going to combine all the budgets from all the provinces, and you're going to say, that's too much money. We need to spend more money somewhere else. Or they're going to say, okay, that seems a reasonable number. Let's work on it and let's achieve what you want. It's very interesting with the budget because technically the budget is going to tell you where you're going in the future and how your future is going to be. So in that case, you don't need artificial intelligence to predict your future. You just need to look at your budget and you're going to see if you're doing the right activities, where you're going to go. Usually the example that I'm giving you, if the budget is prepared for the short-term and long-term plan, and at the end of the day, the budget can establish where you're going to go. Now the question is, if you want to have a healthy society in 20 years, where you should focus spending money now? On which area of life, on everyday life? What do you think? If you're ruling the country and if you want to have a healthy society in the next, to reach it in the next 20 years, where you should spend the government money now? On which area of the spending you should focus? Obviously on the healthcare, correct? Are you guys with me on this? So if you want to have educated society in the next 20 moving forward years, where you have to start spending money today?
Education.
In education. Now the question is, where everybody, which is the budget, part of the budget that all the country now start spending more and more money and increasing that part of the budget. Do you know? All the countries
No.
right now, all across the globe, especially in Europe, they're increasing their military budgets. So if the budget tells you what's going to happen in the future, and if everybody is spending more, increasing their military budgets, what's going to happen in the future? You can easily predict.
More.
So that's why is tell me what you're doing today, and I'm going to tell you what's going to happen in the future. Why? Because through the things that we're doing today, we also predetermine our future. And we can see that through the budgets. Now, what are the on the participative budget? Obviously, there's advantages, and like everything else in life, everything that has advantages has a disadvantages. So let's see what are advantages for the participative budget. If we're preparing that budget based on the participative level of everybody of the organization, individual for all level of organization will be viewed as a member of the team. Sometimes that's an extra motivation for the people and for the employee. And we can use that as a booster for motivation of the people. Second thing is the budget estimates prepare for the frontline managers are more accurate. Why? Because they're the one who actually knows what they need and what they actually again need to in order to achieve the goals and objectives. The next one is that when we ask the people to participate in the budget, that's increased the motivation. And the last one is the managers who are not able to meet the budget when they were the one who prepared the budget, they cannot find excuses for not meeting the budgets. What will be the disadvantages? Again, everything that has advantage has a disadvantage. Well, one of the disadvantages is that this participative budget should be reviewed by the higher managers. Why? Because the lower management can incorporate in the budget what is called budgetary slack. What is budgetary slack? So now listen to me carefully so you can understand it. If the manager, let's say the car dealership, if the manager of the car dealership is measured and rewarded, his bonus depends on the cars that he's selling for the next 12 months. Before the month starts, before the period starts, we're going to ask him to prepare the budget. And we're going to ask him to tell us, okay, for the next period, 12 months, how many cars you planning to sell? If on the normal, if in the normal year, he's selling, let's say, 150 cars per year. And if the bad year, he's selling around 130 cars in the year. And if he wants to achieve his bonus, which is related to the sales, most likely, when you're asking him for the number of the cars that he's planning to sell, he's gonna purposely lower that number. Why he's gonna lower the number? To guarantee his bonus. If you ask him how many cars you're planning to sell in the upcoming year, and you're gonna say, oh, I'm planning to sell 120 cars, when he perfectly knows that in the normal year he sells 150. And once he hit 150 cars, by the end of the year, he's gonna come and say, you see, I exceeded my budget. Give me my bonus. That's why you're on the sales, and you're measuring and you're rewarding your managers based on sales. Now, the opposite is also relevant in terms of the opposite means if we're talking about the production manager who is rewarded and his bonuses depends on the cost savings. So if you ask him what is the anticipated cost for the upcoming period, then he clearly is gonna increase the number of the increase the cost in order for him to get his bonus. Why? Because once increasing the number of the cost, he perfectly know that he can achieve cost savings. And since the bonus is based on the cost savings, at the end of the year, he's going to ask for the bonus. For that reason, top managers reviewing the budget at the end, and if they sense that there's a budgetary slack, then step up and change the numbers of the budget. In the big corporations, and we're going to have this budget committee, which budget committee will be responsible for the overall policy in relation to the budget. They're going to be responsible for coordinating the preparation of the budget, on which level who is involved and to what extent is involved. They're going to resolve any disputes that they may have in the preparation of budget in terms of budgetary slack, in terms of any numbers which don't seem very realistic, and they're going to approve the final budget. Which will be the factors that can guarantee you the success of the budget and process of the budget. First thing is the top managers has to be enthusiastic and committed to the whole process. As you already know, we as a human, we kind of following the examples that comes from the top managers. If we see that our top managers are lazy, naturally we're going to be lazy too. If we see that our top manager are enthusiastic and committed to the process, that's going to engage us as well. So one day when you become a manager, remember that, and remember that what you see in your people is a reflection of you. Some of you are already managers because you manage your family and you're dealing with kids. Sometimes you may wonder why my kids are doing whatever they're doing. And the only reason is it's you. There's no other reasons. Why? Because usually people behave on the way that they see the examples. If you are enthusiastic, if you're energetic, if you're always smiling, the same thing is going to happen with your kids. You already know that. So now transfer this in the business and you're going to understand how you can create a successful company. Successful company is going to happen by itself. It's going to happen from you. If you're enthusiastic, if you're committed, if you show the people how hard you're working, they're going to work the same way. Next thing is the top manager must not use the budget to pressure the employee and to blame him if something goes wrong. So the budget is a plan, but all the companies, I can assure you that all the companies in when the 2020 started had their own budgets. They see what they're going to achieve by the end of the year. Suddenly, coronavirus happened. Now, can I blame my employees that I'm not going to achieve the financial results which I was planning in the beginning of the year? No. Why? Because they didn't have control. They don't have control over the environment. Nobody had control over the coronavirus. When it happens, it happens. And the next thing is, the last thing here is that try to stay with high, highly achievable budget targets. Means that make a targets for the people which are achievable, rather than going too optimistic and put the targets which are not achievable. For example, let's say you're dealing with the C minus student. Is it realistic you to put him on the budget or on the schedule that in the next semester he to become A plus student? Obviously not. Why? Because it's going to take time. It's going to take effort. It's going to take, you have to change your routines, and that's not easy thing. So is it going to happen in one semester? Most likely not. What's going to happen when the semester starts and you're gonna put a budget which is highly unachievable? That's going to frustrate the person, and instead of changing the outcome in the positive way, it can even go in the wrong way. So for that reason, try to stick with the highly achievable budgets. Give the small targets and go slowly through the process of achieving something big. And that's going to bring you to the success. Now, with the zero budget, one type of the budget was a rolling budget, which is also always have 12 months. The other option to prepare the budget is starting every year from zero, which might be an interesting thing, but most people complain that that takes a lot of time and a lot of effort from everybody in the company. So for that reason, what we're going to do is we're going to stay with this rolling budget, or if we have to prepare a brand new budget, we're going to stick with the past results, and we're just going to adjust for the different types of increases that we already know that may happen. Now, on the budget process, overview of all the budgets. I want you to see which is the first budget that we have to prepare. The first budget that we have to prepare is the sales budget. Why? Because definition of the budget was a plan of how we're going to attain and how we're going to use the resources. So in order we to use something, we have to have it. In order we to spend money, we have to have money. From where the money is in the company is going to come? From the sales. So for that reason, we're going to start preparing our budget from the sales budget. Once we have the sales budget, then we can see how we're going to achieve that sales. So we're going to prepare inventory budget for the ending inventory. Once we prepare the ending inventory budget, how much inventory we need to have every period in order to achieve our sales, we're going to start preparing the production budget. Production budget is going to help us to identify how we're going to get the ending inventory, which inventory is going to help us in our sales. Now, on the product side, we have three costs. We have direct material, direct labor, manufacturing overhead. That means we have to prepare three separate budgets. One budget for the direct material, next budget for the direct labor, and the third budget for the manufacturing overhead. Once we have product, that will be the product budgets. The next thing is we have a period cost, which is sales administrative expenses. We're going to prepare that budget. Once we have the product budget and the period budget, we can prepare the cash budget. Once we prepare the cash budget, then we're going to move to the income statement, and the final one will be the balance sheet. So now we're going to start with the sales, and we're going to go all the way through the whole process, so you can see the process, all the way to the balance sheet. So now, in order to do that, I can stay with the slides, or I can move to the Excel spreadsheet. Again, the same Excel spreadsheet that's sitting in for you in the Moodle. So what I'm going to do is, obviously, I'm going to work with the Excel spreadsheet that's sitting for you in the Moodle, so you can see the whole process. I want you to see the process, and we're going to start first with the sales, and we're going to keep going until going to the very end. So I'm interactively going to use the slides, and I'm going to use the Excel spreadsheet. So let's start with the slides. First, in order to start preparation the budget, we need some information. Information will be what will be our sales for the upcoming periods. So this company first prepared budget for the quarter which ending on June 30th. So if we split the year in quarters, that means every year is going to have 4 quarters. Quarter means 4, right? So we're going to have 4 equal periods. 4 equal periods, so how are we going to get it? 12 months divided by 4, that means every quarter is going to have 3 months. Now the question is, where the first quarter is going to start? Now the first quarter is going to start January 1st and it's going to finish March 31st. Where the second quarter is going to start? Second quarter is going to start April 1st and it's going to finish on June 30th. Where the third quarter is going to start July 1st and finish September 30th. Fourth quarter easy, October 1st and going to finish December 31st. And now we have 4 quarters during the year. The next thing interesting is how distant is one quarter to the other quarter. So that will be 1 second. That's how distance is one quarter to another quarter. What that means is the first quarter finish on March 31st, 1959. The second quarter start on April 1st, 000. So what's the distance between the first quarter and the second quarter? 1 second. For that reason, I want you to understand that the ending balance for the first quarter, it will be beginning balance of the second quarter. Why? Because the distance between one quarter and another quarter is 1 second. Nothing can happen in 1 second. Having those things in mind, let's prepare the budget for the second quarter, which ends on June 30th. That means this quarter starts in April 1st. So for that reason, what we need? We need the sales for April, May, June, July, and August. Which sales are given to us? We have the selling price. Once we have the selling price, what we have to do is, I'm going to flip to Excel spreadsheet, which I already have it open. So from the Excel spreadsheet that we're going to have that information, which is going to give us information about the sales. We're going to have our budget sales in April, May, June, July, first quarter, and where the quarter ends. So the quarter ends on, let's get rid of those. So the quarter ends at June 30th, and after that we have 2 more months after the quarter. What's interesting is the selling price. So we're going to have the budget sales. Once we incorporate the selling price, we're going to get the total sales. The selling price is $10 per unit. So for the first month, for the month of April, by selling 20,000 units, that's our projection is to have $200,000. Second month, we're projecting to generate $500,000. And the third month of the quarter, June, we're projecting to generate $300,000. So for the quarter, which start from April 1st and finish June 30th, our projection is to achieve $100,000 sales. Now in July, what we expect? In July, we expect to generate, let's put this formula here. We expect it to generate 250,000. Let's move it to the dollar sign, dollars. And in August, we expect it to have $150,000, as you can see right now. So that's our projected sales based on our projections. So for the quarter, we're expecting to generate $100,000 sales. Back on slides. So once we incorporate those projections into the Excel spreadsheet, as you can see, we're gonna achieve $1 million sales for the second quarter, or the quarter that finished on June 30th. Now the next thing that we have to do is, since we have the sales, let's see how we're gonna collect the sales. Now all the sales are on account. What that means? That means that we're not collecting the cash right away. When we're gonna get the cash? When the customer pays. How the customer pays? The customer pays 70% of the sales are collected in the month of sale. The next 25% are collected in the following month of the sale, and 5% are uncollectible. So every month, 5% of whatever we sell, we're never gonna see it. On $1 million, 5%, that's the money that we're never gonna see. Now on March 31st, our accounts receivable balance was $30,000, and that balance will be collected in full in April. So once we have this information, we can start working on our budget and prepare our budget to see how it's gonna look like. I'm gonna go back to the Excel spreadsheet. And again, if you already downloaded that Excel spreadsheet, you're gonna see that you have the information available. So now, which is the starting point of our budget? The starting point of the collection budget, you have to understand, will be the sales that we're generating from the sales budget. So what we have to do is we have to get the number from the sales budget. We have our sales. So our sales, as you can see, are, I'm going to insert some rows here, and sales, we already have our sales. In April, we're going to sell $200,000. In May, our sales will be $500,000. In June, our sales will be $300,000. In the quarter, our sales will be $1 million. In July, our sales are $250,000. Now the question is, once I have my cells, which are coming right from the above, let's put some different color here. Once I have my cells, which it will be, let's make it exactly equal to the total cells. Once I have my total cells, now I can start preparing the budget. Knowing that for March, I have accounts receivables that's waiting for me, that's going to be collected in April. I already know that. So the March collection will be 100,000, 30,000, sorry. 30,000 is going to be the amount that we have to collect in April. So what we're going to collect in April? First, in April, we're going to collect the 30,000 that's coming from March. That's 30,000 is going to be collected in April. Then, from the sales in April sales, we're going to collect only 70%. So this here will be 20,000 times the 70%. So the money that we're going to collect in April will be $170,000 only. So now you can see how interesting it is. We're selling ourselves at $200,000, but we're not collecting $200,000. We're only collecting $170,000. Why? Because there's leftover from the previous month, 30,000, and this month we're collecting only 70% of everything that we're selling. What's going to happen next month? Next month, in May, first, we're going to collect the 25% left from the April sales. Remember, the 5% we're never going to collect. Plus, we're going to collect the 70% of our May sales. So, in May, we're going to sell $500,000, but we're going to collect only $40,000. What's going to happen in June? In June, first we're going to collect the 25% from May sales.
Excuse me, Professor?
Yes.
Isn't the 25% after the 70% is for April?
Which one?
The second one, the 25%. After the 75%?
So, on which month we're talking? In May?
April.
April?
Yeah, we
So,
have 75% and then we have 25% for April.
we on here, on April,
Yeah,
right? In April, we're going to collect first the $30,000 that's sitting from March, correct?
yeah,
And then we're going to collect 70% of the month of sales. So 70% of whatever we're selling in that month, we're going to collect it. Make sense?
yeah.
So the next 25% of the April sales, we're going to collect it in May,
Okay.
right? But also in May, we're going to collect the 70% of the sales in May,
Okay, then 20% in the following. Okay,
right? So the 25% of the remaining 25% from May,
yeah,
we're going to collect it in
June.
June.
Okay, thank
Make
you.
sense?
Yeah,
And what's going to happen? What else we're going to collect in June? We're going to collect the 70% of the June sales. So as you can see in June, our sales will be $300,000, but we're gonna collect $335,000. So for the quarter, what's gonna happen for the quarter? For the quarter, our sales will be $100,000, but we're gonna receive only $905,000 cash. Now, what's gonna happen with the 25% of the June sales? Well, those 25% will be collected in July. What that means? That means that at the end of the June, of the month June, we're going to have accounts receivables for $75,000, which we know that we have to collect in July because we already did the sales in June. So I'm going to mark it like this, and then we're going to use this information somewhere else at the end of the process. So for that reason, it's good you to know how much will be the accounts receivables at the end of the period. So again, at the end of the June, we know that in July we have to collect the 25% of those June sales, or we have to collect $75,000. Again, we're going to use this information a little bit later in our exercise. That's why I want to highlight it now so we can have it available. Let's go to slides now and catch up with slides. Once we have this, we can start working on the collection budget. Again, in April 1st, we're going to collect the 30,000. Then we're going to collect the 70,000 from April sales. The 25%, the remaining 25% of April sales, we're going to collect it in May. And we're going to keep going until we get the whole idea. Now the question here will be, next month we're going to have again months of sales. In May we're going to collect the 70%, and then we're going to collect the 25%, but we're going to collect it in June. The question is, what will be the total cash collection for the quarter? We already calculated that one for the entire quarter. And we know that that quarter we collect $905,000. So we're done with our sales. We're done with our collection. So we know for the quarter how much our sales gonna be. Our sales gonna be $100,000, and we know how much we're gonna collect. We are going to collect $905,000. So what's the next thing that's coming for us? The next thing that's coming for us, it will be the production budget. In order we to achieve our sales, we have to have those units available for sale in sitting for and produced. So what we need to understand what the management team wants. Management wants ending inventory to be equal to the 20% of the following month inventory. To be equal of the 20% of the following month inventory sales. So we need always to have some inventory. Why do we need to have inventory at the end of the month? So question for you. If you're running a coffee shop, let's run coffee shop for a second. Is it good for you if today you sell all of your coffee? What would you say?
If it's okay?
It's okay.
Yeah.
So is it good for you if you sell all of your coffee?
No, not at the same time, right?
You're not selling at the same time, but is it good if you today, when you operate, you're selling all the available coffee that you have in the store? Is it going to be good for your business?
Maybe not, because we don't have anything for the tomorrow.
Okay, so technically it's a good thing, but it's not good because we don't have anything left for tomorrow. So what's going to happen tomorrow? When 6 o'clock we open, first customer comes and say, "Can I have a coffee?" What are we going to say? I'm sorry,
I don't have.
you can't. Why? Because yesterday I had a very good day and I sold all my coffee. When that customer is going to come again in our coffee shop?
Maybe no more.
Maybe no more. Why? Because he was gonna assume that yesterday we have a very good day. We run out of coffee, right? So for that reason, we once you start doing your business, when you're doing with the customers, please make sure you never run out of the item that you're selling. So always keep ending inventory. For that reason, those people, they don't want to end up with ending inventory. They don't want to end up with zero ending inventory. They always want to have at least 20% of the next month's sales available in the inventory. So how this is gonna help them? That's gonna help them with the sales in the beginning of the month until the productions catch up and start getting the items that they need from production. Make sense? So now, in the end of March, they have already $40,000 units on hand. So they have ending inventory for 4,000 units. Now what we have to do, we have to prepare the production budget. How are we going to do that? Let's move to the Excel spreadsheet and see the next budget will be the production. How are we going to start the production budget? First, again, we're going to get what the manager wants, how much we have in the end of March, and then we're going to start preparation. Our starting point will be, let me delete something first, and then we're going to start working again. So our starting point will be the sales budget. From where are we going to get the sales budget? From the previous worksheet, when we already know how many units we need to sell. Once we go back here on the units to sell, budget sales, we're going to see that we're planning to sell 20,000 in April, 50,000 in May, 30,000 in June, 25 in July, 15 in August. So we get those numbers and we plug it in our sales. Again, in order to achieve these sales, we have to have that balance of items available. Now, in April, we want to sell 20,000 items. But we also, in April, we want to have in our inventory definitely 20,000 items to guarantee the sales of 20,000 in April. But we want to have 20% of the sales in May. So what we're going to do, we're going to add the 20% from the May that we want to have in April. So at the end of the April, we want to end up with 10% of the sales for May. So we're going to incorporate that number. So 50,000 times 20%. So we want to have 10,000 more. So in total, in order to generate $20,000 sales in April and to have $10,000 at the end of the April, we need to produce 30,000 units. In total, we need 30,000 units. Now, do we have anything available at the beginning of April? Yes, we do. How much we have? At the beginning of April, we have the ending balance, which is from March 31st. So on March 31st, 11:59, we have 4,000 units, which 4,000 units become beginning balance of April 1st, 000. So we already have 4,000 units to start the month of April. So the question is, how much we need to produce in April in order to achieve our sales of 20,000 and have the ending balance of 10,000? We need to produce 26,000 units. Once we produce 26,000 units, then we can guarantee our sales and we can guarantee the ending balance that we need to start the next month. So let's go with May. In May, we need to sell 50,000. But we also want to have 20% from the next month's sales as an ending inventory. So how much will be that? In June, we're planning to sell 30,000. So we need 20% of the 30,000 to be available at the beginning of June. So we're going to get that 20%. So we need to have 6,000 more from our sales. In total, we need to have 56,000. But at the beginning of the May, we have our ending balance that's sitting from end of April. So on April 11:59, we have 10,000 units, which is our beginning balance on May 1st, 000. So we already have 10,000 units, which means we need to produce only 46,000 units. Does that make sense? So far, so good?
So, Professor, do I rest what I have on the beginning on the ending inventory from last month, right? The
And that's correct.
10,000?
Yes.
Oh, okay.
Yes. My beginning balance in May is the ending balance in April. Correct?
Yes.
My beginning balance in June will be the ending balance in May. So let's keep going now. In June, we need to sell 30,000, but also we want to have 20% of which inventory now? Of the next month inventory, which is July, correct? So how much more we need to, how much is the 20% of the 25,000? That will be 25 times 20%. We need 5,000 units. In total, we need 35,000 units, but we already have, how many we have?
6,000?
6. We have the 6,000 units, which coming from here. So if we want, we can insert this shape here. So we have this one, and here you can see the link. That the ending balance of April become beginning balance in May. Same thing happened in June. The ending balance in May become beginning balance in June. Make sense?
Yeah.
So, in how many we need to produce in June? 29,000. So let's see how much we need to produce for the quarter. Now we're on the quarter. This one will be at the end of the quarter. What do we need at the end of the quarter? So our sales for the quarter is $100,000. No questions about it. Now we want to add the desired balance that we want to have at the end of the quarter. On which month the quarter ends? Month June, right?
1,000.
What's the ending balance of the month of June?
20.
Five.
$5,000. So the ending balance of the last month of the quarter is the ending balance for the quarter. Make sense? Do you understand this logic? Ending balance for the quarter is the ending balance of the last month of the quarter. So in total, we need 105,000 units. But hold on a second. At the beginning of the quarter, we had the beginning balance. What's the month of the beginning of the quarter?
April?
April. What was the beginning balance in April?
10,000. Oh, 4,000.
4,000. 4,000. Make sense? And then we're having how much our production should be in the month of, in the quarter. So again, watch this. The budget sales, we're calculating sales for April plus sales for May from sales from June, $100,000. Then we're chasing what is the ending balance, desired ending balance that we want at the end of the quarter. Well, the ending balance will be the ending balance of the last month of the quarter, which is 5,000. And then we're getting the total that we need. And then we're seeing how much we had at the beginning of the quarter. And we're seeing at the beginning of the quarter starts in April. So at the beginning of the quarter, we have 4,000. So that 4,000 become the beginning balance for the quarter. So if we have to change it, let's change it here with red. That red becomes here. And let's change this one with blue. And that blue become that blue. So for the desired ending inventory, we're not calculating April plus May plus June. No, we're getting the ending balance of June. And for the beginning balance of the quarter, we're not calculating April plus May plus June. No, we're getting the first balance of the quarter and put it at the beginning of the quarter. And that's how we get the number of the units that we need to produce for the quarter. Now we can start telling our production manager, hey, this is the units that we need you to produce during this quarter. How about in July? In July, we need to have 25,000, correct? Plus, we want to have 20% of the next quarter, which is August, correct? Times 20%. So we need to have in total 28. But we already have 5,000.
5,000.
So in July, we need to produce only 23,000. Okay, that's our production. Let's go back to slides and see what's happened in the slides. Again, we're starting with the sales budgets. Then we start our calculation. We definitely need the sales for the month. Plus, we need the 20% from the following month sales, which is $10,000. But we already have 4,000 from the beginning of April or ending balance in March. And in total, we need to produce $26,000, 26,000 units. What will be the required production for May? We already have answers for that question. Required for production for the month of May will be, let's share our screen, will be 46,000 units. So that will be answer B. And that's the correct answer. So once we run the calculation, we're gonna see that in May, again, we need to sell the guarantee the sales for May, plus we need 20% of the June sales, which is 6,000. In total, we need 56, but we already have the 10,000. So our production should be 46,000. We're gonna complete the information for the entire, and at the end of the quarter, again, budget sales, we're gonna calculate April plus May plus June 100. Desired ending inventory will be for the quarter will be desired ending inventory for the last month of the quarter. Then we're gonna see our needs, and then we're gonna check what was the beginning balance, but the beginning balance of the quarter, which is the beginning balance of April. And once we get that balance, we're gonna see how much our production for the quarter should be. And we're done with our production budget. Once we have our production budget, now we know how many units we need to produce. Now we have to start preparing the 3 budgets for direct material, direct labor, and manufacturing overhead. Now let's start first with the direct material. For the direct material, to make that budget, we need more information. First, we're gonna find out that for every product that we need to produce in the month, we have to incorporate or put in that product 5 pounds of material. Obviously, we don't want to run out of material, so we want to have the material that we need for our production plus the 10% of the next month material for production for the next month. What else we know? We know that at the end of March, we have 13,000 pounds of material on hand. So we started April, the first month of the quarter, with 13,000 pounds of material. So at this point, we have enough information, and now we can start working on the direct material budget to see how much direct material we need in order to achieve our production. Let's go back to the Excel spreadsheet and let's start preparing direct material. I'm going to go to the next worksheet and we're going to have our direct material here, information. Now, what will be the starting point? The starting point will be the production. Remember, we already calculated that our production should be with these numbers. 26 in April, 46 in May, 29 in June, in total 101, and 23,000 production in July. Once we get those one, that will be our starting point, the production. Once we get the starting point, the next thing that we have to incorporate is how many pounds of material we need for one product. And we already know that we need 5 pounds. per material per pounds, material per product. That would be per product in pounds. So we need 5 pounds of material to produce one product. And we start thing. 26 to produce times 5. That's gonna give us, let's delete this row. So I want we to come up with these numbers. If I need 5 pounds per 1 unit and I have to produce 26, that's in total 330,000 pounds of material that I need. Next month, 46 times 5 is going to give 230,000 pounds of material I need. In June, I need 145,000 to guarantee my production. Now, what else I need as a material? I don't want to run out of materials. So what that means, in order not to run out of materials, I need to have at the end of the month 10% of the materials that I need for the next month of my production. So I have the materials for the production in April. Also, I need 10% of the next month. Next month, I need 230,000 materials, but I want to have 10% at the beginning of the month or at the end of the previous month. So we're going to get the ending balance as 230,000 times 10%. That's going to give us 23,000. In total, I need 153,000 pounds of material. If I have those materials, that's going to guarantee me the production, 130,000 pounds of material, plus I'm going to have 23,000 pounds left to start the month of May. But hold on a second, I already have in my inventory from the end of March, which will be beginning of April, I already have 13,000 pounds. So I'm going to deduct that one. So how many pounds I need to have in April? 140,000. So what I'm going to do now, I'm going to call my purchase manager and I'm going to tell him, for the month of April, I want you to purchase and make available in my warehouse 140,000 pounds of material. If I have those 140,000 pounds of material, that's going to guarantee me my production and it's going to give me 23,000 pounds beginning balance for the next month. Now let's see how much material we need to purchase in May. In May, we need 230,000 pounds to guarantee our production. Plus, we need 10% of the next month production. So we're going to get those 10%. So we can start the quarter with 10% or available 14,500 pounds. So in total, we're going to need 244,500 pounds. But we already have, from the previous month of April, we already have 23,000. So let's insert this shape here, this arrow, to show that we already have 23,000 pounds. So for the month of May, we have to purchase 221,500 pounds. Now let's see how many we need to purchase in June. In June, we need to have 145,000 to guarantee our production. Plus, we need 10% to start the next month, which next month is July. So let's get those 10%. 150 times 10%. So in total, we need 156,500 pounds of material. But hold on a second, we already have 14,500 from the previous month, which is our beginning inventory for this month. So how much we need to purchase? We need to purchase 142,000 pounds for June, in order to guarantee our sales and to have beginning inventory for the month of July. So now let's do the calculation for the materials that we need. So first, we're going to get April plus May plus June. So we definitely need 505,000 pounds of material. What else we need? We need to have the desired ending balance at the end of the quarter. And since we know that the quarter ends in June, that means we need to have those 11,000. Sorry, that's not minus, that should be equal. We need to have those 11,500 units. So in this case, again, the ending balance of the last month of the quarter becomes the ending balance for the quarter. Now, so in order, we need 560,500 units. But we already have beginning balance from the quarter, which beginning balance of the quarter is the first month of the quarter, which is also given to us here, 13,000 pounds. So we started the quarter with 13,000 pounds. So for the entire quarter, in order to produce 101,000 units, we need to purchase 503,500 pounds, which will guarantee our production. Plus, we're going to have ending balance of material of 11,500 pounds to start July. Now the question is how much this is going to cost us, but let's go back to slides first to finish this. And then we're going to see how much it's going to cost, how much we have to pay. So again, we start preparations. Our preparations start with the production. We get the production. Then we adding the pounds that we need to produce one unit. And we're getting the total of the pounds that we need to guarantee our production. Then we're going to start adding the 10% of the ending balance that we need for each month in order to start the following month with the ending inventory, with the beginning inventory in this case. So we get that 10%, and we're calculating that the material that we need to purchase for the April is 140,000 pounds. Now the question is, how much materials we need to purchase in May? We already have answer to that question. The only thing that we have to do is go back to the Excel spreadsheet and check how much we need to purchase in May. In May, we need to purchase 221,500 pounds. So let's go back to the slides and plug this as an answer. So the answer will be A, and let's see if that's the correct answer. That seems to be the correct answer. So once we prepare that budget, again, we're going to start with the production needed. We're going to add the 10% for the following month of the material that we need. We're going to deduct the beginning balance, which is the ending balance from the previous month. And we're going to see how much we need to purchase for the month of May only. And then we're going to prepare the next one for June. And then we're going to prepare the last one for the quarter. Again, for the quarter, don't forget, the ending balance in June is the ending balance for the quarter, and the beginning balance of April is the beginning balance for the quarter. Once we get those one, life is easy. Now let's see the next one. Now, once we purchase the materials, obviously we have to pay for that material. That will be our accounts payable. So how are we paying for the material? First, for the material, we're paying 40 cents per pound. And we're paying in this fashion. Half of the purchase is paid on the month of the purchase. The other half is paid next month. Now let's see, is there anything that we have to pay from the left from March? Yes, there's something that we have to pay in April. In April, we have to pay the remaining balance of the payable from the March, which is $12,000. So now let's do the projection and the budget for how much we need to pay for our material. Let's go back to the Excel spreadsheet and let's do this calculation. First, we're going to get the cost. That's 140,000 pounds that we need for April to purchase. It's going to cost us $56,000. The 221,000 pounds and 500 pounds that we need is going to cost us $88,600. 140,000, 42,000 pounds is going to cost us $56,800. So the amount of the material that we need to purchase for the quarter, which is 500 pounds, is going to cost us in total $201,400. So now once we have that one, now we can start doing the projection of our payments. So I'm going to delete those one and we're going to come up with this ourselves. So first, we're getting the cost, again, from the material purchase. We're going to get the cost and how much it's going to cost us each month to pay those one. That will be our starting point. So the cost per pound is 40 cents per pound, and the total will be again our purchase time 40 cents. Fare is 56 for April. For May we need, that's not going to be the number. I have to log this one with F4. 56 in April, 88,600 in May, and 56,800 in June. In total 201. And let's see July. In July I need those one, but I don't have so with the July we're not going to do it in July right now. We don't need July. So now we know on my production. The other thing that I know that in March, from March, I have outstanding balance that I have to pay, which outstanding balance is for $12,000. I'm going to plug it right here. So what we have to pay in April 1st. First thing that we have to pay in April will be the balance for March. So let's pay the balance on March 1st. 12,000, we're gonna pay it. The next thing that we have to pay in April is the 50% of the purchases that I made in April. And that will be, sorry, not that one, wrong. Here, it's gonna be the 50% of total cost for the purchases, 28. So in April, we're gonna spend only $40,000 for the materials. How about in May? In May, we're gonna pay the rest, the 50% from what we purchased in April. Plus, we're gonna pay 50% of the purchase in May. So in total for May, we're gonna pay $72,300. How about in June? In June, first we're gonna pay the 50% left from May. Plus we're gonna pay the 50% from June. In our total, we're gonna pay $72,700. Now, is there anything that we have to pay at the end of June that we haven't paid? Yes, there is. What will be that? The 50% of the June purchases, which we have to pay in July. So here I put the wrong cell, that should be this one. So in July, we have to pay the remaining of the purchases that we made in June, which is 50% of the total purchases. So our accounts payable at the end of July will be equal, at the end of June, sorry, will be equal to 28,400. I'm gonna highlight it and I'm going to put this number because we're gonna use it later in our budget. So now let's go back to the slides and match the slides with our calculation. So again, 40 cents per pound, and we're paying 50% in the current month, 50% the next month. So in April, we're gonna start with the payment of the outstanding balance from March. And then we're gonna pay the 50% and we're gonna keep paying. So how much we have to pay for the entire quarter? We're gonna go and check our calculation. So for the entire quarter, we have to, not this one, sorry, wrong screen. We have to pay for the entire quarter. Interesting. I'm seeing this sharing the Excel spreadsheet, but still not showing me. For the entire quarter, we have to pay $185,000. Let's see if that's gonna check with the answer. So our answer will be A. And A seems to be the correct answer. So once we do all the calculation, we're gonna see that for the entire quarter, we have to pay $185,000. Again, 28,400 is gonna remain outstanding, and it's gonna be accounts payable at the end of the quarter, which has to be paid in July. And we're done with direct material. Now, that was the hardest part of all the budgets. From now on, is easy. Why? Because we don't have to deal with the inventory anymore. As you can see in the production, we have to deal with the ending inventory, desired end inventory. For the direct material, we have to deal with the desired ending inventory. Now for direct labor manufacturing overhead, we don't have to deal with those one anymore. So what that means is that's perfect time for break, and then we can continue. Do you guys want to break? If you want to break, or you want me just to continue? Break?
No break.
We have a break, Prof.
Break, bro? Okay, let's have a break.
Okay.
10 minutes?
Okay.
Okay. Okay, let's have 10 minutes break. So the next budget on the line is direct material and manufacturing overhead in order to complete the products. For direct material, we're going to have some additional information, which is going to show us that this company, in order to produce each unit, we need 3 minutes or 0.05 hours. Company pays has a no layoff policy, so all employee will be paid 40 hours of work each week. In exchange of the no layoff policy, workers agree to a wage of $10 per hour. There is no overtime paid. And for the next 3 months, direct labor workforce will be paid at minimum 1,500 hours. So what that means is this policy, just to explain a little bit, means that if the workers work 37.5 hours, they're gonna be paid 40 hours. If they work 30 hours, they're gonna be paid 40 hours times $10. If they work 15 hours per month, they're gonna be paid 40 hours times $10. But if they work 45 hours, they're gonna be paid 45 hours times $10. So what they're missing is, they're getting the benefits if they work less than 40 hours to be paid minimum 40 hours, but they're sacrificing if they have to work more than 40 hours, they're not going to be paid overtime. So additional $5, they're losing that one. So it's kind of fair thing. The other thing is that means that every month they're going to be paid minimum 1,500 hours. So that means if the total hours is below 1,500 hours, they're going to be paid 1,500 hours. But if they're above, they're going to be paid the actual hours. So let's see how we're going to do this. First, since we know how much time they need to produce, to make the production, or 3 minutes per production, we're gonna start with our production budget. Production budget will be the one that we starting for. So we know that they need 3 minutes or 0.05 hours. So we're gonna estimate how many hours they need to complete the production. So for the month of April, they're gonna need 1,300 hours. For the month of May, they're gonna need 2,300 hours. And for the month of June, they're gonna need 1,450 hours. Since in April, they're working less than 1,500 hours, we're gonna pay them 1,500 guarantee. For the month of May, they're working over 1,500 hours, so we're gonna pay them the actual hours. And month of June, they also work below the 1,500, so the 1,500 is gonna prevail. So we're gonna pay them 1,500 hours. So in total, we're gonna pay them 5,300 hours. In total, we're gonna pay them for $53,000. Let's go now to slides. And let's see how the slides dealing with the situation. They should deal exactly the same way. Again, they're starting with the units of production. Then they adding the 3 minutes or 0.05 hours, and they see how many hours are required. Then we're checking, comparing with the 1,500. If the hours are below the 1,500, we're paying them 1,500. If they're above, we're paying them the actual hours. So in total, we're going to pay them for 5,300 hours. And since we pay them $10 per hour, the total expense will be $53,000. That's very straightforward. There's no scary part here. Now the question is, what will be the total direct labor cost for the quarter if the company follows the no layoff policy? They still follow that policy, right? They still paying the minimum 1,500 hours. But for the month that they exceeding 1,500 hours, they paying them extra $5 for every hour over 1,500 hours. What will be the correct answer? Let's go to our Excel spreadsheet and let's start thinking about it. Now I'm gonna just before I start sharing this, I want to make some adjustments and then we're gonna start thinking about it and see how much we have to pay. Here we go. And that's our Excel spreadsheet now. Now, first, we already know the production which is required. We know how many hours per unit are required. Let's get rid of this. So we need 0.05 hours. That will be 0.05 hours all across. So technically in the first month, April, times 5, we need 1,300 hours. But since minimum we have to pay them 1,500, so we're going to pay them 1,500. The question is, in the month of April, do we have excess of 1,500 hours?
No.
No. So we pay them minimum $10, right? So how much will be our cost? Our cost here will be the amount of hours that we minimum that we paying them times $10, we pay them $15,000. In May, we need total hours of $2,300, 2,300 hours. Do we have excess over 1,500 hours?
Yes.
Yes. How many hours are those?
800.
800 hours. For the 800 hours, we're gonna pay them now for the 1,500. We're gonna pay them $10. For these hours, we're gonna pay them guaranteed $10. For the rest, we're gonna pay them 15, correct?
Yeah.
800 times 15. And we have our numbers. What's gonna happen in June? In June, they're working 1,450 hours, which is below 1,500. So 1,500 is guarantee. We don't have excess over 1,500. So we're gonna pay them the guarantee $15,000. In total, how much we have to pay them? The answer will be D, $57,000. So let's see if that's gonna match with our slides. So our answer was D, and that will be the correct answer. Again, we pay them guarantee 1,500 in April, 1,500 in May, 1,500 in July. That's 4,500, $10. The excess over 1,500, we pay them $15. That's 12,000, total $57,000. That's how we're done with the direct material budget. Now we have to move to the manufacturing overhead. For the manufacturing overhead, we need to have a little bit more information. What will be that information? The information it will be first. Just a second, I want to make some adjustments on the Excel spreadsheet before we move to the Excel spreadsheet. So the adjustments, the information will be company manufacturing overhead is applied to the units of product based on the direct labor hours. Now, this is not the direct labor, not the hours that we paying to our employee, but the actual hours worked. Variable manufacturing overhead is $20 per direct labor hour. So for every hour that the worker is working, we're gonna add $20 manufacturing overhead plus 50,000 per month fixed manufacturing overhead. 20,000 of this fixed manufacturing 50,000 is for the non-cash item, which is the depreciation. Now we have to prepare that budget for the manufacturing overhead. Let's go to the Excel spreadsheet and get this budget done. Now, having that everything in mind, what we're gonna do is we're gonna calculate, we're starting with the direct production. We're gonna see how many hours we need to produce that production. So the actual hours was 1,300 in April, 2,300 in May, and 1,450 in June. For those hours, we're going to apply $20 manufacturing overhead, variable manufacturing overhead, and we're going to see that our variable manufacturing overhead costs for the quarter is $101,000. And that will be our total manufacturing overhead. Then we're going to add the fixed manufacturing overhead, which is 50,000 and doesn't change from month to month since it's the fixed cost. So all the months will be 50,000. So in total will be 150,000. So our total manufacturing overhead for the quarter will be $251,000. Now we have a non-cash item. So if we have to calculate the cash that we're paying for the manufacturing overhead only, we have to eliminate that non-cash item. So we're going to deduct this $20,000 non-cash item, which is related to depreciation. So the cash that we're paying for the manufacturing overhead only is $191,000, or 56 in April, 76 in May, and 59 in June. Now, the next thing that we have to do is, since we have the total, this is our total manufacturing overhead, and we have our total hours to get this manufacturing overhead, what we can do is we can calculate the predetermined manufacturing overhead per unit, or which will be the unit of measure, that will be per hour. And 251,000 divided by 5,050 is going to give us the predetermined manufacturing overhead of $49.70. Why do we need that one? To come up with the cost per unit. So let's go back to slides and move to that cost per unit. First, let's go quickly over the manufacturing overhead. Again, we're getting the direct labor hours that we need to produce our production. We're adding the $20 per hour. We're getting the variable overhead. Then we're adding the $50,000 fixed cost, and we're getting the total cost, which is $251,000 based on the 5,050 hours budgeted. As you can see, this is all estimated. Since we're on the budget, we're doing estimation. And from those two numbers, we can get that the predetermined overhead rate is $49.70. And we completed eliminating the depreciation, and we're seeing how much cash we're gonna pay for the manufacturing overhead. Now let's do the ending finished goods inventory. For the ending finished goods inventory, what we need is the cost per unit. So what we have is we have the direct material. For every unit to produce, we need 5 pounds, and each pound costs us 40 cents. So that means $20 per unit. We need direct labor, which for direct labor is 0.05 hours, which every hour we're paying $10, so that's give us 50 cents per unit. And the last thing was the manufacturing overhead. We already calculated our manufacturing overhead. Calculations show us that we gonna have $49.70 per hour. And since we spent 0.05 hours per unit, times 49.70 is going to give us $2.49. So every unit that we're going to produce is going to cost us $4.99. Now the question is, how much is the ending inventory? Now for the ending inventory, we have to check how much was the ending inventory of the production at the end of the quarter. So for that reason, I'm going to go to the Excel spreadsheet because it will be very easy to find it. So once we have, again, here on the Excel spreadsheet, we're going to see the direct material, 5 pounds, 40 cents, that much. Direct labor, 0.05 hours, $10.50. Manufacturing overhead, 0.05 hours, 49.70. Unit of production, cost per unit is $4.99. Now the question is, how much was our ending inventory? Ending inventory, we're going to go to the production. And we're going to, from the production, we're going to see that the desired ending inventory of products at the end of the quarter was 5,000 units. So our ending inventory on the end of the June was 5,000 units. And 5,000 units cost is $4.99. So that's going to give us the cost of our inventory that's sitting in our inventory account is $24,950. Now we're done with the productions. We cover everything that we can cover in production. So the next thing that we have to move is so we have this number of ending inventory. We calculated that we have 5,000 units. So our cost of the inventory is $24,950. Now we have to start with our period cost. Period cost is the sales and administrative expenses. For the sales and administrative expenses, we're going to see that we're dividing into the variable portion and the fixed portion. Now, the variable component is related to the sales. So our salespeople, for every unit that they're selling, we pay them 50 cents. Plus, for all the selling administrative expenses per month, total is $70,000, which is fixed cost. Out of those $70,000, $10 are related to the depreciation, which is non-cash item. And now we have that information to prepare our sales administrative cost budget. So what will be our starting point here? Our starting point will be sales. So let's go to the Excel spreadsheet. And let's start working with the Excel spreadsheet. Again, our starting point, since we have all this information about the sales and administrative expenses, we're going to start with the sales. From the sales budget, right from the beginning. how much we're selling, we plug it here. We have our sales. We know that our rate, we're paying them 50 cents. Let's pay them those 50 cents. So our variable expense in April will be $10,000. In May will be 25. In June will be 15. In total, $50,000. Plus, we're going to have the fixed cost, which is $70,000, which is not going to change from month to month. In total, our sales administrative expenses will be $260,000 expense. Now, how much of those we have to pay as a cash? Well, we have to eliminate the depreciation because we're not paying cash for depreciation. So the $10,000 depreciation when we get it, part of the fixed sales administrative expenses. So the cash that we have to pay is $230,000 only. And that's the end of all those operating budgets. Now, what will be the total cost for the quarter or total cash that we have to pay? We already calculated that was $230,000. And the $230,000 comes from once we plug the variable portion, 50 cents per sales, fixed cost, 70,000, minus the $10,000 depreciation, it's going to give us $230,000 cash that we have to spend. Now, the next thing, the last three elements that we have to do. We have to do the cash budget. Sorry, just a second. We have to do the cash budget. We have to do the income statement, and we have to do the balance sheet. Let's start with the cash budget. Cash budget probably will be the most important. But we cannot get the cash budget if we don't have the previous budget. So for the cash budget, what we need to know. First, we need to know that we're going to have 4 sections here. First section will be for the cash coming in. Second section will be cash going out. Third section will be difference between cash coming in, cash going out. And the fourth section will be if the cash is more than what's going out, what we're going to do with it. Can we invest it? Can we do something about it? Or if it's less, if cash going out is more than cash coming in, from where we're going to borrow and how much we're going to borrow. So in order to do this, we need a little bit more information. What will be that information? First, the company has a credit line, for which credit line is pays $16,000 and it's for $75,000. Next thing is they want to have minimum cash of $30,000. So whatever they're doing, whatever they're spending, we have to give them $30,000 cash all the time. On the borrowing, they borrow on the first day of the month, and we're paying the outstanding, whatever they have outstanding, at the last day of the month. Just for simplicity. They pay cash dividend $49,000 in April, which we have to incorporate in our calculation. They purchase in May 143,700 equipment and 48,300 in June equipment, which pay with cash. And in April, they started with $40,000 cash. So now we have to do our cash budget. Again, probably the most important budget, because once you go to the bank loan, the bank's going to ask you, show me your cash budget. How are we going to do this? Let me erase everything first, and let's do it together. First thing first. I'm going to delete this borrowing, and I'm going to leave this one. Actually, you can get rid of everything. So first thing first, we started the April with $40,000 cash, which we have at the end of March. So $40,000 cash, we have it. Then we collected some cash. How much cash we collected? We have to go to the sales budget and see how much we collected. In April, we collected $170,000. So we're gonna put those 70,000. 170. So in total, we have April, we have $210,000 cash. Then we pay cash for direct material. From direct material budget, we're gonna get the cash that we paid, $40,000 for the materials. We pay for direct labor. We're gonna go to direct labor and see how much we paid. So we paid our employee $15,000. We pay for the manufacturing overhead. So we're gonna go to manufacturing overhead budget and we're gonna see how much we paid cash. We paid cash $56,000. Then we paid for the sales administrative expenses. From the sales administrative expenses budget, we're gonna see that we paid $70,000 cash. And now we have to check the question and see, is there any other cash that we paid? And they say, in April, we paid $49,000 dividend. So if they want dividend, let's give them the dividend, $49,000 dividend. So in April, we spent $230,000. So we overspent $20,000 more. Now, current balance of cash is minus 20. We want minimum cash, that will be minimum. We want minimum cash of $30,000. So that means we have to borrow. How much we need to borrow in order to bring our current cash to the $30,000? Well, obviously, we need to borrow $50,000. Once we borrow $50,000, our ending cash balance will be exactly the minimum cash that we want, $30,000. And we're done with April. Let's see now May. May, our cash is the beginning of the May is the ending balance of the cash in April, which is $30,000. Then we're going to collect our sales for May, which was $400,000. Now we have $430,000 cash available. Then we're going to get the cash for direct material, cash for direct labor, cash for the manufacturing overhead, and cash for the sales administrative expenses. There's no dividend. We're not paying dividend again. So there's no dividend here. But we purchased some equipment of $143,700. Now at this point, we spent $400,000, which is less than what we collected. In fact, we have exactly $30,000 more cash than we spent it, which magically become our minimum balance at the end of the month, which matching our minimum cash balance. So in that case, for the month of May, we don't have to borrow extra, but we don't have excess cash to pay any of the borrowing that we already borrowed. And we're done with May. Now let's see June. June, we're gonna start with the ending balance in May, which is $30,000. That's become the beginning balance. Then we're gonna collect our sales, which is $335,000. So in total, we're gonna have $365,000. Then we're gonna spend cash for direct material, cash for direct labor, cash for the manufacturing overhead, and cash for the sales administrative expenses. Again, those numbers are sitting on all those budgets. We're not paying dividend. We already purchased the first equipment, but now we have to purchase the second equipment. For the second equipment, we have to pay $48,300. Let's pay those $48,300, and let's see where we are. Now we end up with $270,000 spending. So at this point, we have cash excess, $95,000. Now we need only minimum 30. So we have $65,000 excess. Once you see the excess over the minimum cash balance that you carry, check, is there anything that I borrowed from before? Yes, there is, $50,000. Can I repay that borrowing? Well, definitely we can. How much we can pay? Everything. So let's pay them everything. $50,000, let's see if it has to be positive or negative. No, it has to be negative. Let's pay them $50,000 to the bank. If you pay $50,000, we're going to stay with $45,000, which is above the minimum. So we're fine. Unfortunately, we still have to pay interest, and we're paying interest 16% per year, annual interest. So for how many months we borrow those money? For 3 months. So what we have to do? We have to do simple calculation of 50,000 times 16%, 0.16. 0.16. But that will be the annual, right? If you do this, that will be our annual interest. We're paying the interest only for 3 months. So what we're going to do now? If it's annual, we have to bring it to for the 3 months only. So there are 2 options here. First, divided by 12 if you want, and then times 3. Or you can get the interest 16% times 3 divided by 12 times the amount that you borrow. Either way works. And times 3, because only for 3 months. And we have to put the minus in front because we're paying those money. So we have to pay only $2,000. And with the repayment of the loan, so now we don't have any borrowing, we pay the interest, and we end up with $43,000 cash, which is above the minimum cash that we need. So again, this probably is the most important budget. Why? Because every bank's going to ask you for this. If you have this budget, you can borrow money. If you have this budget, you can project where you're going to be. Don't start your business if you don't have this cash budget, because the cash budget is going to tell you which month you are below, which one you're above. If you see here only minus, 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 that means that business is not for you. Pass it. Don't start that kind of business. But again, you have to prepare this budget before you even think to start your business. Once you see the positive, see when you're going to start generating cash. Once you see generation of cash and you're happy with the numbers that you see, go for it. Then the only thing that you have to make sure is make sure the sales, you're achieving the sales. So once we're done with the cash budget, the only 2 that left are the income statement and the balance sheet. So again, the cash budget, we're starting with the collection. We're going to add all the expenses. We're going to see that we're below. We're going to borrow in order to achieve the minimum balance, and we're going to keep going next month and the next month. So what's the excess deficiency available over the disbursement for June? We already calculated. That was I believe, $95,000. Let's stay with the $95,000, and we are correct. So the $95,000, we have it available. We're going to pay the outstanding borrowing plus the interest for 3 months only. This is different calculation that we can do. And you're going to get the cash available. Now, once we're done with the cash budget, again, left income statement. For the income statement will be straightforward. There's nothing scary now in the income statement. Why? Because we have all the information. From where we go to get the information? First, we know how many units we're selling. We're selling 100,000 units from our sales budget. We're selling 100,000 units and our sales are $1 million. So we're getting the sales, $1 million. Cost of goods sold. We already know that we're selling 100,000 units. We already know that every unit cost us $4.99. So we get our cost of goods sold. We're getting the gross margin. In the cost of goods sold, remember, we have direct material, direct labor, manufacturing overhead. Next thing that we have to see is how much is our operating expenses. For the sales administrative expenses, we're going to come here and we're going to see that our operating expenses are $260,000. We're going to incorporate 260 and we're going to get the income before interest. From the cash, we know that we're paying $2,000 for interest. We're going to incorporate those $2,000 and we're going to see it for the quarter, for the second quarter, we're going to generate income of $239,000. So let's go to the slides and see these numbers. Again, we're getting the sales from the sales budget. We're getting the cost of goods sold based on the units that we're selling, time cost per unit. We're adding from the sales administrative budget the sales administrative expenses. We're deducting the interest expense from the cash budget, and we're getting the net income. Once we're done with the net income, the last thing that we have to prepare is the balance sheet. Now, for the balance sheet, we're going to add a little bit more information for the property, plant, and equipment information. How much is the land? How much is the equipment? Also, we're going to add the common shares, and we're going to see how much is the retained earning at the beginning of the period, of the quarter. And then we're going to prepare that cash budget. Balance sheet budget. So let's share the screen with the balance sheet. And that's where we're going to end up today. With the balance sheet will be the last one. So first we're going to get the cash from the cash budget. From the cash budget, we know at the end of the period, we have $43,000 cash. We're going to get the cash. Accounts receivables from the sales. Remember, we highlighted that our accounts receivable $75,000, which is going to go directly to the balance sheet, $75,000. Raw material. Now we have to go and see how much raw material we have from direct material. From the direct material, we're going to check how much ending balance we have for the raw material. And we're going to find out that we have 11,500 pounds raw material left. But we already know that each pound costs us 40 cents. So that's going to give us the raw material of $4,600. Finished goods inventory, we already calculated on the finished goods of the cost of goods sold that the ending inventory of the finished goods is 24,950. We're going to add that one, 24,950, and we're going to have current assets of $147,550. Then we're going to add the land, 50,000. Then we're going to have add the equipment. Now we're starting with 175,000 plus from the cash. we see that we purchased first 143,700 and 48,300. That's total of $192,000, which we're gonna add to 175, and we're gonna see that our equipment, now we have equipment for $367,000. So the total assets will,
Professor,
yes,
sorry, but can I go now because I still have to go to work?
yes, go. If you have to go. Recording will be available. Don't worry about it. I just want to finish
Okay.
this.
Okay.
After,
Thank you,
for
Professor.
no problem. For those of you who have to go. I just want to finish this, and we're gonna stop. I don't want to stop in the middle. So let's.
Thank you, Professor.
No problem. So for the liabilities, we're gonna get from the direct material. We're gonna see how much we have to pay at the end of June. We have to pay outstanding 28,400, which is 28,400. Then we're gonna add the common shares from the information that we have, common shares. And the last thing left is the retained earnings. Now for the retained earnings, what we're gonna do is for the retained earnings, we're gonna get the beginning balance, which beginning balance is right from here. 146, 150, 146, $150. We have that beginning balance. Then what we're gonna do? Then we're gonna add the net income. We're gonna add net income from our income statement, which net income was here. It's gonna be equal to 239,000. Once we add that number, then we're gonna deduct less dividend, which dividend we paid. We already know that we pay from the cash. We paid 49,000 dividend. And once we have those numbers, we're gonna get the retained earnings ending balance, which is gonna be equal to the beginning balance plus net income minus dividend paid. 336, 150, and we're gonna plug it right here. And that's how we're gonna prepare the balance sheet. So let's see what the slide's doing, and we are done with this. So for the slides, again, we're gonna get the cash from the cash budget, accounts receivable from the sales budget, raw material from the direct material, 11,500 pounds times 40 cents. Finished goods, 5,000 units for $4.99 per unit. Then we're gonna add land, equipment, the current equipment, plus the additional purchases, accounts payable, common shares, and calculation of the retained earnings, beginning balance plus the net income minus the dividend, and we're done with the balance sheet. And that's where we're gonna stop. This will be our ending point of this chapter. So far we prepared this static budget. Now next time we're gonna see how we can move on from the static budget and where we're gonna go with the static budget and how to prepare the variances. So thank you for today. Thank you for your patience. Thank you for staying with me a little bit extra. Apologize for this extra delay of 10 minutes. But again, you're going to have your recording.